Hello, welcome to the weekly technical analysis review here at xm.com. I'm Rafi Barajan, currency analyst, and today is Monday, January 22nd, 2018. Today we're going to be looking at the dollar yen, the euro dollar, the pound dollar, and the dollar franc pairs. Let's begin first with dollar yen. We can see the near-term bias is to the downside with the RSI below 50 and tilting slightly downwards. Dollar yen did hit a 4-month low 110.18. That's just above the 61.8% Fibonacci retracement of the upleg from 107.31 to 114.73. So that low was touched last week. Another attempt below that level would only deepen the current bearish bias and then open the way towards the 109 handle. Just below that handle we have the 78.6% Fibonacci at around 108.90, and then a drop below that level would open the way towards that September low of 107.31. If on the other hand we do see today's slightly upside momentum gaining further strength, resistance should come from the 111 handle. That's the 50% Fibonacci retracement, and then a successful climb above that level. We could see the pair targeting the 111.90, 38.2% Fibonacci level, and then it would then be able to target the 50-day moving average, currently around 112.33. Moving now on to euro dollar, which is still looking bullish at the moment in the near term, although the near term the strength of the near-term bullish bias has eased somewhat. It had reached overbought levels last week. It dipped slightly below the 70 overbought level and is flat at the moment. So that points to further consolidation in the near term around current levels. If we now quickly have a look at the 4-hour chart, there is immediate support coming from around the 1.2210 area, and then not too far below that, around 1.2165, which is where the 50 period moving average is in the 4-hour chart. A breach of those support levels would then take the pair towards the 1.21 handle, and then the key support after that to watch out for would be the 1.20 handle, which is the 50% Fibonacci retracement. On the upside, though, which at the moment is a more likely direction, prices would first need to break above last week's 3-year top of 1.2322. So the rally stalled just below the 261.8% Fibonacci extension, which is around 1.2370. So that's the next key target for euro dollar, and then above that we have the 1.25 handle, followed by the 1.2650 area, which is the 423.6% Fibonacci extension. Let's move on to pound dollar, and pound dollar is also looking very bullish at the moment. We can see the medium-term outlook has been becoming more and more positive, with the MACD continuing to climb higher and above its red signal line. If you look at the RSI, though, to have a more better picture of the short-term bias, we can see RSI has dropped a little bit but remains above the 70 overbought level. So clearly there is a risk for a near-term downside correction, but for the moment it is holding comfortably near that 1.5-year high 1.3944 it made on Friday. And the reason why the rally stalled there, it is because, of course, that is a key resistance area. That is the 261.8% Fibonacci extension of the downleg from 1.3549 to 1.3302, coming in at 1.3947. A successful breach of that resistance level could then take prices towards 1.4345 as the next target, which is the 423.6% Fibonacci extension. To the downside, we should see support coming from the 1.38 handle, and then further down we have the 1.37 handle. A breach of the 1.37 handle would weaken the bullish bias and could open the way towards the 1.36 handle, which had been a key resistance level in the past. But it does remain still comfortably above the 50-day moving average. That's currently around 1.3440. So it's unlikely we're going to see any deterioration of the bullish bias in the near term, but obviously a breach of the 1.37 handle would increase the risk of a move back towards the 50-day moving average. And our final pair for this week is dollar Swiss franc, which is in bearish territory at the moment. We can see the stochastics are below the 50 level, although they are trending upwards. We can see the percentage K line positively aligned with this percentage D line, and we can see prices did manage to recover sharply on Friday from that low of which was around 0.9530. It briefly spiked below the key support area of 78.6% Fibonacci retracement of the up leg from 0.9419 to 1.003. Another attempt to breach that support level would take prices towards that 2-year low we saw back in September of 0.9419, and that would only exacerbate the bearish outlook in the medium term, which we can see from the MACD has been deepening. It is below the red signal line and is still falling. On the other hand, if the current upside momentum gathers some strength and prices manage to break above immediate resistance at the 61.8% Fibonacci at 0.9655, that could open the way towards the 50% Fibonacci at 0.9730, and then above that the 0.98 handle would come into focus, and we can see that's a very critical region there, with both the 50 and 200-day moving averages currently standing near that level. That's it from me. Thank you very much for watching and have a great day.